Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so the next topic that we're going to address is the concept of accrued interest. And this is one of those sneaky topics that nobody likes to address, but they do test this quite a bit. So we're talking about a situation where bonds are issued between interest pay periods. So just like the landlord of your apartment building would never charge you rent for the time period in which you didn't actually occupy the unit, we're not going to be charging the borrower interest for periods in which they didn't actually own the bond. Okay, so other than the effective interest method for amortizing bond discounts and bond premiums, the concept of accrued interest is the second big item that we need to address. And when it comes to accrued interest calculations, the two items that we really need to focus our attention on is going to be what the face value of the bond is and the stated interest rate. Okay, so why does that sound familiar? Because that is what we'd use to calculate the periodic interest payment. So they can ask you how accrued interest is going to be calculated, right? How it's going to be reported. And they can also ask you how this is going to affect the beginning carrying value of the bond at the date of issuance. So unlike issuance costs, accrued interest portion of this issuance is going to be added back to the beginning carrying value. All right, so this is going to require additional journal entries to account for this accrued interest at the time of the sale. So we have another systematic approach that we need to consider. All right, so we're building another mental map specifically for accrued interest, because it is just that complicated, right? People struggle with this quite a bit. All right, so initially we're going to be focused on that periodic interest payment. Okay, so this is going to be what? That's going to be the stated rate times the par value. And the name of the game is going to be allocating the portion of that interest payment for the initial interest pay period to which we did not own the bond. Okay, so that is what we're applying to accrued interest. Okay, so I always like to compare this concept to the concept of rent, right? So let's say you move into your first apartment. You're paying $1,000 a month, right? And let's say that you move in on January 15th, but rent is due on January 30th. So you're going to pay on January 30th, but are you going to pay the entire month's rent? No, that would be ridiculous. You're going to pay only for the 15 days that you actually occupied the space. Just like the borrower is only going to pay interest for the time period that they own the bond. So the portion of this payment that represents the amount that we do not own the bond is going to represent our accrued interest, right? So that's the first 15 days on the rent. Okay, so we're not paying for the amount that has been accrued. Okay, so we're going to pull out our 4-step approach. This is very specific to determining what's going to be applied to the beginning carrying value of the bond, right? So we're adding something back, and that is our accrued interest. Okay, so accrued interest is going to be added to the beginning net carrying value of the bond. So step 1 is going to be determining the carrying value of the bond, right? Nothing's changing there. Now, step 2 is determining what is the amount of the first interest payment without considering accrued interest, right? So this is step 3 under the effective interest method mental map. Okay, so this is just calculating the interest payment without even considering anything, right? This is just the normal interest payment calculation. Okay, so step 3 in the accrued interest 4-step approach is determining what is the percentage of the first interest pay period in which the bond was not outstanding. So what does that mean? What we're saying here is that if we bought the bond on, let's say, February 1st, and let's say that the interest payments are made quarterly, so we're not going to pay for this first interest payment until March 31st. So the first month, that would be January, we didn't actually own this bond. So that's going to be 1/3 of the interest pay period that the bond was not outstanding. So in this case, 1/3 of the interest payment is going to represent our accrued interest. And finally, in step 4, this is the easy part. That amount that we just calculated, we're going to add to the amount of the beginning carrying value. Okay, so we're just adding the calculated accrued interest back to step 1. Okay, so taking a look at this accrued interest example, the company issued a 12% $1 million bond due in 4 years on March 1st of year 1 for $940,288. The market rate on the bonds are 14%. The interest is paid semi-annually on July 1st and December 31st. We want to know what is the bond's carrying value at the date of issuance. Okay, so this looks pretty familiar, but the only difference here is that the bond was issued on March 1st of year 1. We know it's a semi-annual interest payment, with the first pay period being July 1st, right? That's the date that the first payment is going out the door. So that first payment is the primary amount that we're focused on. Okay, so starting with step 1, we're going to determine the carrying value. They just gave it to us, $940,288. When it's all said and done, we're adding something back to this amount. Step 2 is determining the periodic interest payment without considering accrued interest. Right, what's the otherwise normal periodic interest payment without considering that accrued interest amount? In other words, this is step 3 under the effective interest method. So we're taking the face value and multiplying it by the stated rate. We know this is a semi-annual interest payment, so we're going to have to divide both rates by 2. But once again, focused on the stated rate. So we're going to divide 12% by 2 to give us 6%. 6% multiplied by the $1 million face value gives us semi-annual interest payments without considering accrued interest in the amount of $60,000. Okay, so step 3 in our 4-step approach is determining what is the percentage of the first interest pay period in which the bond was not outstanding. In other words, if this was rent, how long did we not occupy the space? Right, if we rented an apartment on January 15th and we pay rent on January 30th, we're only going to be paying for January 15th through the 30th. Right, the landlord isn't going to make us pay for January 1st through the 15th. So the bond was issued on March 1st. So the accrued portion, right, the portion that this was not owned, was for January and February. Okay, so that is 2 of the 6 months that the $60,000 is being paid for. In other words, that's $10,000 per month that this is being accrued. So in other words, for January and February, this is the portion of the first payment in which the bond was not actually owned. So that's going to be $10,000 for January and $10,000 for February. $20,000 represents our accrued interest. Okay, so they'll generally ask you for step 3 or step 4. Step 3 being the determination of accrued interest itself, in this case it's $20,000, or step 4, determining the beginning carrying value after considering accrued interest. We know the beginning carrying value is $940,288. All we would do is add the $20,000 of accrued interest. Okay, so the initial issuance price, right, that beginning carrying value would now be $960,288. So now we can begin the amortization of bond discounts or bond premiums by applying the effective interest method. Only the beginning carrying value, right, that starting point, is $960,288, not $940,288.